All right, I think I'm live. Hey, everyone. Welcome to another episode of Market Trading. I'm your host, Vays, and I thought I might as well stream, right? Like the rate decisions in 5 minutes. The bots are going to run the market crazy. And let's go straight to the charts so I can get ready and see where the market's going. Let me just organize some windows here and see what's going on. So while I was in Twitter Spaces with Swan, I finally had the time to get back to working on that data set from the US government. About 30 seconds to spend on this. Come on, Zoom. Gonna cooperate or what? Okay. Yeah, so I got this crazy data set, and now we have something to work with. We have how much money the government's made all the way to 1934. This is how much money the government spent by department, going back to like 1962. And right now I'm working on how much the government spent by function. I'm just like transposing all this data because it's like in horrible formats. Well, mostly like this. This is what I've been working on all day today. There are super functions, there are functions, and then there are sub functions, and then there are sub functions. So once the data actually, is in a readable format for me, I can start playing around with that data. Let's go to the charts. Let's see what's going on. This is the daily chart. Daily chart looks good. We got 3 minutes, 3 minutes and counting. Where's the short-term chart? Okay, so we broke this line. I started streaming this morning. The moment it was breaking this line, I don't know why this arrow starts there. It should start here because I did this stream the moment this. I know why, because it was should have been right there. I had the 1 hour chart up. You can see exactly which candle broke my line. We broke the line at 9 a.m. I started streaming at 9:15. So there you go. We did pull back already. But you should not be holding Bitcoin going into the rate announcement. That's just absolutely crazy because it can swing in either direction. So now what I'm going to do is in the next 30 seconds, we're going to go to a 1 minute chart on the S&P. We're going to go to a 1 minute chart on Bitcoin. And we're going to prepare. The market's already starting to go down. The insiders always have the knowledge. They can see the bots can see the look on Powell's face, and they're already analyzing it. And the bots are already going nuts. Ignore the MRI stuff. It's not going to matter. Let's line these up. The initial reaction is probably going to be down, then up. That's what it usually is. Where's that document? Oh, you know what? I have the hard paper. Well, anyway, let's see. See, Bitcoin tends to be the leader here because it reacts faster. It's easier to move Bitcoin. It's a little harder to move the stock market. Either way, this thing is going to fly in about 30 seconds. Let's just watch. Meanwhile, I'm going to look for that paper. FOMC. Should do a search for drift. I also have pictures of it. I should probably just pull up an image. All right, here we go. 5 seconds. Yep, initial reaction down and then up. That's how it usually goes. And then up, boom. Initial reaction down, then up. I'm assuming it's 25 basis points or nothing. I'm not even looking at what they said. I'm just looking at the market. Whatever it is, the bots are happy. And there it goes. Off to the races. 25, yep. I assume as much. But the bots have already read the statement. The statement's already out. The bots have already read the statement. And in that statement, I can probably tell you what it says. It says that they are going to reassess the situation because of the problems with the banks. And they will be more careful in how quickly they raise rates. Let me find that picture of the FOMC chart. I gotta have a picture of it. What the hell is going on? There it is. Whoa, 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 whoa. What the hell just happened? Interesting. Very interesting. Hold on, let me show you this. This is the historical reaction. We'll get back to the chart in a second. It's the historical reaction, right? You see, if I zoom in on this, you see a little bit of down, and then up, and then down big, and then boom, swing up. Let's see if this is how the day is going to end. This is the traditional FOMC drift. Tweeted this out a while back. Data since 1994. The last update, I think, was in 2018. Someone should do an update. It's been about 5 years. Stock market's still hanging in there. But remember, Bitcoin leads. Bitcoin leads. There's a 1-minute chart. You can see that Bitcoin crashed lower than this prior green candle. So I'm not surprised the stock market on current candle is dumping hard. Bitcoin is turning first. You're not going to be able to use the stock market to enter your Bitcoin trades. You may be able to use Bitcoin to enter stock trades, not the other way around. I still think it's going to be a bullish day. Daily chart. Daily chart still not in danger. We made a swing high. We made a high of 28,860. We're ticking back up. Yep. Well, if you had a stop loss, you got screwed. But you shouldn't have been trading here. I am bullish here. You can see how Bitcoin is trading with the stock market minute by minute. Now, Powell's going to speak at 2:30, I believe. I'll stick around. We can hear him live. I don't mind listening to him speak. Man, Greg Foss really hates Jerome Powell. He thinks Jerome Powell is grossly incompetent. So this is where Greg Foss and I disagree. I actually think Powell is one of the better Fed chairmen the U.S. has had in a long time. He might be a lawyer, but I do think he understands what he's doing. And he's doing what is necessary to be done. Stock market is breaking to new highs. I want to see it by percentage here. Okay, let's put this in the middle. It's a 1-minute chart. Let's see by percentage. At least they're both. Which candle is this? 1405. 1405. Okay, that's right. By percentage, I want to put it right. I want to put it at the high. Bitcoin was up 1%. Stocks. was up 0.5% at the high on the first candle, but stocks have already broken it. And there goes Bitcoin. Bitcoin's going to break it as well. Beautiful. Beautiful. We're about to break 29. Back to the picture. So this used to be at 2:15. Now it's at 2 o'clock. And this would take about 15 minutes. So the low would be made in the first 15 minutes. We've already passed that stage. It happened a lot faster now. Remember, this is an old graphic. Things are happening faster. And the high usually comes in. But back then, they didn't really speak. They kind of just released a statement. Now he's actually doing a speech. Oh, this looks great. Ignore the green stars. They don't really matter. Looks beautiful. S&P on the weekly. S&P on the weekly needs to close above this cluster of support / resistance. Depends on how far you look back. What's GBTC doing? I don't know. We're on a 15-minute delay. I can't see what GBTC is doing for another 15 minutes. Well, the market is going to move again once Powell starts speaking, right? So it's impossible to say. But I can see us going close to 30K today and between in the next 24 hours. The day is not over yet, though. This is a very tricky day. A lot's going to depend on what Powell says and his body language and his eye contact. There's a lot in there. They're not going to ask him any hard questions, so you don't have to worry about that. Check out gold. Sure. Oil. We talked about oil earlier today. Oil's rising. I heard someone said the dollar was dumping. It doesn't look like gold's doing anything. Gold hasn't done anything. Unless I'm on a delay. I'm on a delay. I have a delay. Data is delayed 10 minutes, so I have no idea what gold did. This data used to be in real time. They made it. I don't have my broker connected to it. I mean, for some reason, Interactive Brokers didn't really connect to this. Pulling back a bit again. I mean, at this point, I would set a stop loss somewhere near these lows. I would not want to be in a Bitcoin bullish trade if it goes below these lows. So below 28,28450, I would not be very bullish short term. So Bitcoin needs to stay above 28,450. Otherwise, my stop loss would take me out of the bullish trade. But I wouldn't be in a bullish trade right now. Not from a short term. It's just too volatile of a day. I would have already exited before the Fed call. Like I said earlier, I had no problem going long. Oh, not that one. Had no problem going long right here on the hourly chart. But you got to get out before the announcement. Hopefully not at your entry. Hopefully you got out a little bit up here. We could have gone higher, but didn't happen. Right now, I would have a stop loss on my bullish view, short term. By short term, I mean like day trade. Still bullish for a minute. And we got 20 minutes before Powell speaks. Bitcoin is generally correlated with risk assets because Bitcoin is both a risk-on asset and also Bitcoin is also a competitor to gold, that it is a store of value. So Bitcoin has both sides. Bitcoin could be correlated with gold for the reasons people buy into gold, and Bitcoin is correlated with stocks for the reason people buy into stocks. Very few people buy into gold to speculate on gold. People buy into gold for a non-volatile asset. When is the announcement? What announcement? I mean, the announcement already happened. That's why the market moved, and then Powell's going to speak soon. Hey, moderators, thanks for throwing in the question. I already answered it, though. Is investing.com real time? It used to be. All this stuff used to be real time. I don't know. Maybe the brokers aren't letting them do it anymore. I have no idea. Or CME wants their piece of the wants a cut or something. I'm 25 basis points, I'm assuming, because the market would be up like 10% if it was 0, and the market would be down 10% if it was 50 basis points. So the only logical conclusion is that the Fed raised it 25 basis points. I can take a look at gold now. Whoa, is that gold? Shit. Look at that. Nice. Nice. Yeah, well, I'm sure a dollar crashed. Let's look at TLT. This in real time or on a delay? I mean, TLT is hanging in there. The dollar. Oh, that's a monthly chart. No wonder it's hanging in there. Gotta go daily. Why does he need to speak? He doesn't need to speak, but I mean, everyone wants to hear from him because they want to know where to gamble their money. And the dollar is, I wouldn't say it's dumping. It's down a little. It's down a bit. Dollar will be fine. I'm not worried about the dollar. And now the question becomes, what's the probability of the next rate hike, right? Yeah, 99.9% for yeah, well, too late now. We already know what happened. So the next one is May 3rd. And wow, these people actually, oh no, I'm sorry, I thought it was 50 basis points. Yeah, it's 50-50. This makes sense. 50-50 whether he's going to raise it or not. No, wait. See, this is saying, well, this is now wrong, right? Anyway, we have to look at this tomorrow. We have to look at it tomorrow. Makes no sense to look at it today. It doesn't make sense today. Okay, so at the moment, I'm not all that bullish, but once he starts speaking, whole new effect coming in. So are we down on the day or what? No, we're still up on the day. Still a bullish candle daily. Still a daily bullish candle. Hey guys, I grabbed a tequila bottle, so I'm gonna be listening to Powell and having a drink. I haven't had a drink in a while. I usually drink aged tequila, but I'm trying to get myself to be more sophisticated, sort of, I guess, or the other way around, more traditional. And I bought a couple of Blanco tequilas that I know are clean, no additives, no nothing. Still not a fan of the Blanco, but trying to see if I can learn to like it. Okay, we got 15 minutes in. We can see GBTC. We can take a look at how the premium is moving. This is Bitcoin on a 1-hour chart. You know, we're still above the breakout line. And now we have a 1-hour moving average that played as support. We had a new swing high, almost hit 29. We came close. Let's see how far we can get. Well, weekly still okay, daily still okay. I mean, Bitcoin is just TA bullish. We just got to get through today. Yeah, we're now at 475.5. I hate the fact that it's a range. So annoying. It should be just one number. It makes life so much easier. I wouldn't pay too much attention to the MRI stuff. Like, it's kind of cool that the MRI support line's holding, but I think that's just luck. I'm going to pour myself a drink so that I can listen to Powell. It'll be more interesting. There should be like a drinking game based on how many times he says the word inflation or something. How strong is the housing market? I actually think it's fairly strong. I just sold my condo. I got a decent price. I don't want to jinx it, but another family member is about to sign a contract to sell their house at a decent price. I think the housing market's still okay. I know it's an example of two people, but if someone wants to buy something, they buy something. People want to sell it, they're selling it at a decent. I think the housing market's still doing fine. Yeah, let's check GBTC. The discount is slowly getting smaller. That's great. Until GBTC discount breaks the 30% discount barrier, it's not that interesting. Once it breaks this 30% barrier, it starts to become a lot more interesting. Yeah, they do post at 2 p.m. They released a statement and they released the rate. I don't know what it says. FOMC decision. Right. I mean, they would have released a statement. I don't know if we can get the statement. This could be a link to the statement. I don't know. There is a statement released. The Federal Reserve officials emphasize, yeah, like that's a quote from the statement. The statement reads, right? Like where is the statement? This is why, like, these publications are horrible. FOMC, it's probably on their website. Yeah, here it is. There's a statement. Right. Now, you can't read this as fast as a bot. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation has eased somewhat, but remains elevated. Russia's war against Ukraine. Wow, is this the first time he mentioned Ukraine? That's huge. It's causing tremendous human and economic hardship, and it's contributing to elevated global uncertainty. The committee is highly attentive to inflation risk. The committee seeks to achieve maximum employment and inflation at the rate of 2 target. So there it is. There's your statement. Committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, economic and financial developments. There's your statement. Oh, it's a statement from February. Shit. Okay, so where's the latest one? There is a statement. It's out there somewhere. Here it is. That's the statement. Thank you. This is the statement. There. U.S. banking system is sound and resilient. There it is. Thanks for having pointed that out. I haven't even started drinking yet. More tequila. Need more tequila. Yeah, I do. There's the statement. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects are uncertain. And we're going to listen to him speak in a few minutes. In uncertainty of a stance of monetary policy, the committee will continue to monitor the implications. The committee will continue reducing its holdings of Treasury securities and agency debt. That doesn't sound very bullish. And agency mortgage-backed securities. That doesn't sound very bullish. As described in its previously announced plans, the committee is strongly committed to tightening. Yeah, so they're still being hawkish here. That's not dovish. That's hawkish. In determining the extent of the future increase, the cumulative. Yep. Anticipates that some additional policy firming may be appropriate in order to maintain a stance on monetary policy. Yeah, this is that's not. That's a little hawkish there. It's a little hawkish. See, right now this looks ugly. This is ugly. If we break this line, that is ugly. We've now established a lower high on a 1-minute chart. And that is an ugly looking support line. And it's going to be hard not to break that line to the downside. And if it does, bam. Like if I was in the middle of a trading competition, like our 6-hour trading competition, and I saw this, I would be going leverage short big right now. If I was in a trading competition with fake money. Not trading advice. We do have a 6-hour trading competition as part of the financial summit. Who can make the most money in 6 hours right here? Who can make the most money in 6 hours? It's great. Usually the winner makes about 10%. That's been our average. Between 8 to 10% wins the contest. We've already done this 3 times. I almost won. I came in second place once. And if I saw this pattern in that contest, the moment this line's broken, I'd be going short. Or I'd already be short and losing the contest. My stop loss would be at this high right here. Because we've established a lower high. Now it's a matter of breaking the floor. I want to see Bitcoin go up, but the TA right now is not very bullish. When Powell starts speaking, let's just say this is a 5-minute trade. I'm going to go off screen share for 1 minute. Yeah, so I bought a couple of Blanco tequilas because I didn't know Bitcoin was going to go up this much. I thought it would be in a pullback. So this is a very good tequila, Tequila Ocho. It's in my top 10, or just outside the top 10. It's really hard to find Blanco top 10 tequilas because they're not around much. This is about a $40 bottle. For someone looking for a very clean tequila that is cheaper, not in the top 10, but no additives, no nothing. We have one more. I haven't opened this yet. That's Cimarron. This is a $20 bottle, super cheap. If you're on a budget and you are looking for a Blanco, normally I drink my extra añejos, but I don't have any at the moment. So we're gonna go with Tequila Ocho. It's in my top. It's just at my top 10. We're just outside the top 10. And I'm not a fan of Blancos. I'm trying to learn Blancos. I don't even have any ice. Like I never drink. I never drink inside a house. I only drink when I'm like out with like company. But here it is. I don't even have proper tequila glasses. We're gonna wait till Powell starts speaking. Yeah, it does. The tequila really does smell like agave, which goes away when you age it. All right, let's go back to the charts. All right, we never broke that line, and now we're approaching the other line. This is why a day like this, I would never actually trade on a day that's volatile. That was an example of chart patterns that I would use when one guy isn't driving the market. I still think it's going to break down. I still think the breakdown is more likely than a breakout at the moment. Once we cross that red line, everything changes. Like this is technically a no trade zone. We are in a no trade zone with a descending triangle. The odds are higher to the downside. Wait, I'm going to wait till he starts speaking before I start drinking. Stock market's rising. Stock market is about to break prior swing high. I do want to see Bitcoin go up. So if I did take the short trade, I'd be like happy losing money because it would be a very small portion. Meanwhile, the savings are making money. All right, let's even out the candles. All right, now I'll be bullish. Welcome to trading on a volatile day. We break that red line. It shouldn't be red, it should be green. Break the green line, I'm bullish. Break the red line, I'm bearish. Very simple. It's not simple when you have money on the line, but very simple when you're making a YouTube show. Let us stop playing around with candle size. Same thing for the S&P. Above the green line, I'm bullish. Powell's about to speak. Let's turn it up. Let me transfer the audio. All right. Let's see if I can get the speaker closer to the microphone without it like crashing. Maybe I'll just turn it up. Yeah, this is the Fed. This is the government's budget. I've been messing around with this data. I'm trying to put it in a really good format. Let's go back to the chart. Let's move these over. Oh, I may have to do like the screen share.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced.
You guys hear it?
And makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be
inflation. Take a sip.
My colleagues and I understand the hardship that high inflation is causing, and we
Second
remain
sip.
strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising.
Oh, come on.
Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the term of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection, the SEP, for total PCE inflation is 3.3% for this year.
That's not looking good.
Next year, and 2.1% in 2025.
Shit.
The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous
this is going to be bearish.
Economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP,
I've just been listening. I've been paying attention. I'm 3 cents behind. That sucks.
Funds rate based on what that participant judges to be the most likely scenario forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors.
So they are looking to lower rates.
Projections are not
starting next year.
Plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation.
Okay, I think I caught up. Oh, nope,
you
just said it again.
Bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions.
Should have got a better tequila. Should have got a major one.
Is essential to set the stage for achieving.
Just said it like 3 times in a row.
Stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Good question.
So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So
good follow-up.
We did consider that in the days running up to the meeting. And you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we need to raise rates over the course of the year, more than we expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening of financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused as always on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect.
I'm so confused
about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time. And in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
You're concerned that the hike you did today could further exacerbate the problem in the bank?
Good question.
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation of the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC.
I don't like that question.
And, the people who write the minutes will be very carefully counting, but I'll tell you what I heard.
It's just not
what I heard was
useful.
Significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do. And that therefore they
I
were
like that ascending triangle though.
that in their assessment, and that if that just turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SCP forecast. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And it, you know, in a way, the data in the first 5 weeks of the intermediate period pointed to stronger inflation and stronger labor market. So that pointed to higher rates. And then this latter part, kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
You know, we know that we have other tools in effect, but no, we think our
It's already been asked.
tool works.
Come on.
We think,
Give them a hard question.
many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Ask him what happens to the national debt and the interest on national debt. Ask him about duration of the
Hi, Victoria
government
Guida,
bonds.
Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue
That's a
was
decent
really
question.
not about those specific banks, but about the risk of a contagion to. That was the issue.
Okay, and then can you also, just to follow up, can you
Didn't hear
speak
that.
to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, you know, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, you know, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times. The process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug, but so
I like
yeah,
that.
absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6
Crap, I
months.
gotta drink again.
It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, you know, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustainable it be? That's the issue, and we don't really see it yet. It's so people are making estimates. You know, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for, you know, being alert as we go forward, as we think about further rate hikes. for us, we'll be paying attention to the actual and expected effects from that.
Ask him how much he hates Janet Yellen.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit. I know that you've got
New
your
York Times.
coming, but I wonder if you could talk a little
Not
bit
good.
about what you think happened with oversight at Silicon Valley Bank.
Ask him about the
What do you
woke
think
agenda.
That something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
Surprised you didn't ask why aren't there more women working at the Fed?
And then I'll come to
New York Times.
the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation. And I assume that, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they hitting this totally wrong from the Fed, or is there something different about
they are.
way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
It's actually a good
We
question.
published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember,
It's a weird question. Like, he doesn't know.
Monetary policy tool. We're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be. Obviously, at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
That name sounds super familiar.
Hi, Chair Powell.
Washington
Rachel
Times?
Siegel from the Washington Post. Thank you.
Oh,
for
Washington
taking our
Post.
question.
Shit. Here we go. This is so bad.
About how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional
Why do they
banks
keep letting her in?
disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentration of people having commercial real estate.
God, she
And
has
really
the
don't think
worst
it's possible
questions.
For this, the banking system is strong, it is sound, it is resilient, it's well capitalized. And I really don't see that as at all analogous to this.
Exactly.
Would you be open to an independent investigation separate from the Fed's probe?
I welcome that. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome when a bank fails their investigations, and of course we welcome that.
Oh my God, they stop letting her in. She has the worst questions every
Edward
meeting.
Lawrence from Fox Business. Inflation has been rather sticky. So do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities. And
Oh, come on, grow a pair.
We take fiscal policy as it comes to our front door.
Call out the Treasury.
A million other things. And
Call Yellen a
we have
troll. Let's
responsibility.
go.
Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
No, you won't.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation.
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
They still have no idea what drove inflation up. Wow.
Hi, Chair Powell, Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
That
Sure.
terrible question. What the hell is Axios?
13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, and which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals?
Was he not listening to the other guy asking the same question and the answer?
If we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things And of course, we will eventually get to tighten up policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So
Not useful.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer term securities. Large scale purchases of long term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer term rates, which supports demand through channels.
Whoa, market doesn't like something.
The balance sheet expansion is really temporary lending to banks to meet the special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course,
I'm glad you think so.
To change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that?
All right, I'm getting bored. I don't know about you guys. I don't know if I can listen to this anymore.
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting.
I kind of want to listen to it all because I got to be on Spaces later and talking about this.
There have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value.
Stop blaming the banks for you raising the rates so quickly. That's insane.
I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair.
Yeah, I'm still bullish on the S&P.
Try to understand.
Maybe not for the next 48 hours, but I'm still bullish on the S&P.
What policies we need to change. I mean, one thing is the speed of I'll come back to that. The speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible, regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
The board had a bunch of diversity hires with their political connections that had zero experience. No wonder you didn't answer the question. That's hilarious.
Thank you very much. Chair Powell, you stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets fails, are you promising to bail out all of its depositors?
Well,
he's not.
I'm not saying
the bailout guy.
So, but what I'm saying is, you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system. and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Great, no answer.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government.
It's their problem,
Were
not his
following it
problem.
over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Hi, thank you, Chair Powell. Nicole Kind with CNN Business.
Oh boy,
In
here we go.
of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
That's
So
a
that's an estimate.
terrible question, but I was expecting that.
What will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that. And
I'm already out of
back to
tequila.
where we need to be, back to where we were for a quarter century.
It's an inflation way too many times. I haven't eaten all day, so I don't exactly want to drink another double shot. God, she's so useless.
Historically, it's been hard
Oh,
to
no.
contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections?
No, he doesn't.
It depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down. And because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in. And
This was one of my extra añejos. I would.
Or
I can't drink that much Blanco.
You can have very, very long expansions without high inflation. And we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to
I really don't listen to
at
this
the lower
anymore.
end of the wage spectrum. It's just a place that we should try to get back to.
Hi, Chair Powell.
This is not looking good.
I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
Really? I think that ship
it's
has
too
already
early to
sailed.
say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention and citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. And I guess there were.
And how are you going to ensure that banks comply with these citations, take them serious? Like, how will you enforce them?
That is a great question, and is right in the heart of what the review will be doing. Or that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
I have specific thoughts on that.
Well, I see. If I did, I wouldn't share them, because I really, this review is going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want.
Just stop raising rates so quickly. Jesus, why is this so difficult?
Thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again, Vice Chair Barr's leadership, and I'm confident that it will produce satisfactory results.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So
not the best question, because it's already been asked 3 times, but
that's not something we've discussed yet.
Not
As I
the worst
mentioned, we're
either.
always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a.
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes.
I think we're done here.
Today, because those traditional indexes are.
All right, I want to cut that off. I think we're done. Okay, so let's see where we stand. We broke below critical floor and crashed. 1 minute chart. And then we rallied a smidge above that line for a back test. Reversed on a 1 minute MRI, which I would not have really paid attention to. And then took a big leg down. And the moment we broke below the prior swing low, shit really hit the fan. All right, I can't seem to, there it is. So this is where shit really hit the fan. So I think we're close to finding a low. That is the type of candle that puts in a low for the day. A candle like that. Got 45 minutes left in the market. I really like this candle. Again, if I was in a trading contest, I'd be going long off this candle with a stop loss below that candle. That's a beautiful gravestone doji. The best candle in this entire downturn to reverse the market. That's the candle you want to see. That's literally the perfect candle to reverse. What does a 1 minute candle mean? Not much, but this is the type of candle that you look for in order to go long. Follow through came the candle after, and now we're going higher. The worst is probably over. I will take the bet that we go up from here and close higher than the low of this candle on both Bitcoin and stocks. I think it's over. He raised 25 basis points. The expectation is he's going to lower rates by end of year. I think that expectation is wrong. I don't think he will, but we'll see where it goes. There's a Swan Spaces going on that ends at 4 p.m. Eastern. I got 45 minutes to get in there and say my piece. I'll probably do that. We're gonna take a look at the higher level time frames. Bitcoin has fallen to that prior area of support. Not a big deal. As I've stated earlier, this is the one we got to watch out for. We have a 1 hour long-term moving average. Just a reaction to the Fed call. I think we're okay. We're still within this range. We can now move this up. We now have a new range. The next time we go above that range, Bitcoin's gonna take off nicely. Not a big deal yet. All looking good. We're not gonna close the day as a green star candle. Hopefully this consolidates a little bit longer. Moving averages catch up, and then we go higher. We got 700 live viewers, which is absolutely awesome. We're gonna take a sneak peek at the other markets. I like that GBTC discount is now at 35%. It's approaching the lowest it's been, or the highest it's been this entire year. I think we'll break that in the next couple of weeks. So that's a good sign. Oil is rising, dollar is dropping. Oil had a beautiful daily MRI buy, which I saw it a couple of days ago. Didn't start paying attention till today. To the daily, I usually look at the weekly. Natural gas is not looking good. Surprising. Gold's looking okay. I like the breakout in gold. We have stocks really need to close strong this week, above 4,000. They absolutely must. I think they will. And the 1 minute chart, which I'm going to switch back to the daily chart. Oh, no, I'm going to leave it as a 1 minute chart. Maybe I'll make it a 5 minute chart. And I think the low is in for the day. Beautiful 5 minute candle as well. I'm sure it's going to look great as a 10-minute candle too. On a 5 minute candle, I'll stay here for another minute and a half. I'll flip to a 10-minute candle and leave it there. I'll put a mark on it just so I see tomorrow where I anticipated the low to be. I'm going to delete all these marks. They don't, I mean, otherwise they're going to just stay there forever. They were drawn a 1 minute chart. They did their purpose, served their purpose. Flip to a 10-minute chart. Beautiful reversal candle there as well. On Bitcoin, I'll wait till next candle. And then we're going to call it a day. You can catch me for another 30 minutes over at Swan's Spaces. And see you guys tomorrow morning. God, they got to stop letting Siegel from Washington Post into those meetings. She asks the worst questions. We'll take a look at the regional banks tomorrow. I don't want to look at stocks. I'm just waiting for the candle to flip. Give it another 30 seconds. Lock in. Well, what I thought was going to be a hammer is now locking in a doji. Equally as good. There's your next candle. On a 10-minute chart, bullish trade activates above the reversal candle. On a 5-minute chart, that's already happened. On a 10-minute chart, it's there. on a 5-minute chart that already took place above the hammer candle. And we go from that point. We'll revisit this tomorrow and see if this low held. All right, guys. Thank you all for watching, and I will see you all on the next one. Don't forget to check out the website for the Financial Summit. Follow us on social media. We post a lot of financial analysis every day with the research team for the Bitcoin conference. Come and visit us at Unconfiscatable in Las Vegas. Bye, guys. Oh, forgot. Check out the interview that Swan did with me and Mark Moss. It was absolutely awesome. It was really, really good. I tweeted it out. I'll tweet it out again probably today. Awesome interview. Me and Mark Moss and I. Let's use proper grammar here. Check out this interview. It aired earlier today. Bye, guys. Spaces is a Twitter competitor to Clubhouse. Later, guys. Financial Summit right there. November 5 to 10.